There is one gap, Graham said, you must never close. Every investor who went broke had closed it. Buffett calls it the 3 most important words in investing. Not a stock tip, not a formula, a gap. Today you learn how to open it and keep it open. By the end, you can price a business the way he does. You start with the real problem that the gap solves. You will be wrong about a company. Often. Not because you're careless. The future is simply unknown. Earnings slip. A rival appears. A recession lands. Graham lived through 1929 when fortunes vanished in weeks. He watched careful men ruined by one confident guess. So he built a rule for being wrong safely. The rule has a name. Margin of safety. Picture a bridge engineer, not a stock chart. She must carry trucks across a wide river. The heaviest truck weighs 10,000 pounds. So does she build the bridge for 10,000? She does not. She builds it for 30,000. 3 times the load it will ever carry. That extra strength is not waste. It is the margin. Why so much? Because she cannot see every future. The cheap steel that was weaker than the mill promised. It absorbs the rusted bolt she didn't see. The flood heavier than any on record. The truck overloaded past the posted limit. She builds for 30,000 and drives 10. The gap between them is where mistakes go to die. Investing works the same way once you see it. A business is worth something. Whatever the market says today, that worth is its intrinsic value. The price is what a nervous crowd will pay this morning. Graham's method lives in the space between the two. Value is what you get. Price is only what you pay. Buffett wrote that exact line. He learned it from Graham. When price sits far below value, you have a margin. When price rises above value, you have a trap. So the skill is 2 steps. Estimate value, then demand a discount. Skip either one and you're gambling, not investing. Do both, and you turn odds in your own favor. Let's do it with a real, simple business. Call it a corner grocery. You can see the whole thing. This is the point. Value only what you understand. A grocery, not a mysterious tech company. If you can't explain how it makes money, you can't value it. So we start where the answer is plain. First question. What does it earn in a normal year? Not the best year, not the worst, a normal one. You read the books, sales, costs, what's left over. Rent, the clerk's wages, the apples that spoiled. After paying everyone, the owner keeps $100,000. That's the profit, real money the owner takes home. Now the second question, what is that stream worth? $100,000 a year coming in steadily. You wouldn't pay 1 year's profit for the whole shop. You'd pay for many years of that profit up front. A steady, dull, reliable business might be worth 10 years' profit. 10 times 100,000, $1 million. That is your rough estimate of intrinsic value. Rough, not exact. Graham insisted on that word. He said you don't need the precise weight of a man. You only need to see he is clearly fat or clearly thin. $1 million business could really be worth 800,000 or 1.2 million. You cannot know exactly. And that uncertainty is exactly why the next step exists. You have a value, about $1 million. That number is step 1. Most people stop there. Knowing value is not the same as buying well. Here is the trap most people walk into. They find a good business and pay full price. Value 1 million, price 1 million, no cushion. If they're right, fine. If they're wrong, they lose. Now watch the value investor do it differently. He will not pay $1 for $1 of value. He wants 60 cents for that dollar or less. So on $1 million grocery, his price is 600,000, not a penny more, no matter how much he likes it. That $400,000 gap is the margin of safety. It is the bridge built for 30,000 pounds. Now let the unknown future do its very worst. Suppose you were too optimistic. The grocery was never worth $1 million. Only 800,000. A new market opens down the street. Sales soften. You were wrong by $200,000. A full-price buyer just lost that money. But you paid 600,000. The business is still worth 800. You are wrong and still ahead by 200,000. Your error was smaller than your discount. That is the whole point of the number 60. The bigger your discount, the bigger a mistake it forgives. That is the whole trick. You can be wrong and still win. The discount did not just find you a bargain. It bought you the right to be human, to misjudge. Graham built his whole book on that one idea. He put it plainest in the last chapter of his book, chapter 20, The Intelligent Investor. He wrote that the margin of safety is the central concept. He wanted a motto that captured sound investment. Everything else in investing, he said, flows from it. Buffett read that chapter at 19 years old. He said it rearranged how he saw money forever. Decades later, he still calls those words the framework. 3 words. Margin of safety. Not buy low, not think long term. It is that gap. Now the ways people get this wrong. First mistake, they skip step 1 entirely. They never estimate value. They only watch the price. A falling price feels like a discount. It isn't. A discount is price below value. No value first. Second mistake, they shrink the margin when excited. A wonderful company tempts you to pay full price. Graham's answer never changed. Demand the discount anyway. The better it feels, the more your confidence lies to you. Third mistake, they forget the margin is for being wrong. It is not a bonus. It is not greed. It is armor. You buy the discount, hoping you never need it. Like the bridge that carries the flood, it was built to survive. So here is your Monday morning method. 1. Only look at businesses you actually understand. A shop, a brand you use, a company you could explain to a child. 2. Estimate its yearly profit, then value it roughly. Steady profit times a modest number of years. 3. Cut that value hard. Aim near 60 cents. That cut price is the most you'll pay. A ceiling, not a target. 4. If the market won't sell that cheap, you wait. Most days it won't. Waiting is the job, not failing at it. 5. When a panic finally hands you the discount, you act. You buy the dollar for 60 cents and you hold. 6 steps, but the whole discipline is in the discount. Everything before it just tells you what a discount means. Notice what this method is really doing. It does not ask you to predict the future. It does not ask you to be a genius. It asks you to leave room for the future to surprise you. The genius is admitting you'll be wrong and pricing for it. Humility written into the price you're willing to pay. That is a skill you never age out of. A confident investor pays full price and prays. A safe investor pays 60 cents and sleeps. The bridge engineer never learns the exact flood coming. She simply builds for far more than she'll ever need. Do the same with every dollar you invest. Find the value, then refuse to pay full price for it. That gap is the difference between an investor and a gambler. It is the one rule that keeps you in the game long enough to win. Graham gave you the whole thing in 3 words. Margin of safety. Now you know exactly how to use it. If this helped, the next lesson covers how to value a moat. Subscribe.